Yes, sir.
Good afternoon, all. Good afternoon, all. Uh, CA Sanjay Nikam, Regional Council from WRC here, and it is a sense of pride and privilege for me to host this meeting webinar organized by the Tax Committee of ICAI on the topic of issues related with the Section 56 to 10. Friends, to start with, I'd like to inform you that we have today with us. That Tax Committee Chairman Piyush Chatterjee is also Chairman, Central Council member of ICAI, and also MD Prachapati sir. He's going to share his views on this topic. He's going to be a faculty for a day. Uh, at outset, let me introduce Central Council member Piyush Chatterjee, who is the chairman of the Directors Committee, for your better understanding. Piyush Chatterjee is a 25 has an experience of more than 25 years in the fraternity. He is BCom FCA DISA qualified. Has completed his college graduation from NM College of Commerce Mumbai. Current role senior partner with Mr. Chajar and Doshi Chartered Accountancy firm, and he's residing at Mumbai. CA Piyush Sohan Raj Chajet, having brings 25 years of extensive experience as a senior partner at M.H. Chajet and Doshi Chartered Accountancy firm, a distinguished firm located in Mumbai. His educational background boasts a bachelor degree in commerce from NM College of Commerce and Economics at Mumbai. He also holds diploma in information system audit. His rich educational foundation has equipped him with the knowledge and expertise to excel in the intricate realm of finance and taxation. He is an expert in tax litigation and advisory. CFPO charges has made significant contribution to the finance and accountancy landscape on both national and international level. Notably, he was a member of a Central Council of Institute of Accountants of India from 2022 till 2025, and the second term from 2025 till 2029. Within the ICI, he has served all the three pivotal standing committees: executive, examination, and finance committee, showcasing showcasing his multi-facet understanding of the profession. He is currently chairman of directors committee and vice chairman of expert advisory committee. He was a member of the working committee of Asian Federation of Accountants. He is currently technical advisor of International Auditing and Assurance Standard Board and member of committee to study fiscal regimes and other statutory requirements of business in SAARC countries of South Asian Federation of Accountants. He is on the board of Wimplast Limited, Cello World, and Multibase Limited. In addition, his contributions extends to the Reserve Bank of India, where he held a key role as a member of External Advisory Committee for Asset Reconstruction Company. His dedication is also evident in his proactive involvement in the creating and sharing knowledge. He is the regular contributor to Direct publications, offering insights and interpretations that help shape the discourse within the taxation community. His contribution to the WRC publications on Vivase Viswas Team 2020 and his role as a reviewer of FAQs on charitable trust published by the Joint Chartered Accountants Federation highlights his commitment to disseminating valuable information. Beyond his professional pursuits, C.H. Hajar is actively engaged in various trust organizations where he serves as an independent director, honorary board member, honorary vice president, and trustee in the different capacities, further showcasing his commitment to social and community welfare. So, friends, it is a privilege and honor for us to present before all of you Directors Committee Chairman and Central Council Member Piyush Chatterjee. I request Chatterjee to share his valuable insights with the members.
Thank you very much, Sanjay Nikamji, Regional Council member from WRC, and in fact, he is also a chairman of Direct Tax Committee of WRC, and who is doing a lot of work at the Regional Council level, and he's working hand on hand, and we have been talking a lot on this direct tax subjects. the senior chartered accountant, the speaker, MD Prajapati ji. Thank you very much for joining us and agreeing to address the gathering today. And very good afternoon to all the esteemed members who have joined to this Thursday webinar, which Direct Tax Committee does, everyone. Yes, I know this time the timings have changed. Generally, people would be looking forward to a time of 3:30 or 4 o'clock. But this time, considering various other programs going on, we decided that we'll do it at 2 o'clock. Probably, maybe you would have just finished your lunch, or you would be about to take a lunch, or along with the lunch, you would be getting the knowledge of Section 56. So I hope, in fact, you will be able to devote more time because this is a relaxing time also between 2:33, and hearing MD Prajapati would be great. Coming to the Direct Tax Committee, obviously you are hearing me on every Thursdays also, but very important point which I would like to bring it to your notice. You would be aware, I don't know how many of you are would aware, that we have already released now an exposure draft of guidance note. As you all know, guidance note was last revised in 2023. Thereafter, we had come out with an implementation guide in 2024 to cover the revision in Form 3CD and the amendment which were made through a Finance Act 2024. That time we didn't revise the guidance note because the Finance Act itself came in July, and generally September is the last date of tax audit season. This time the Finance Act was amended in 2025 through Budget 2025. It got President assent also before March itself, and there was again a revision in Form 3CD. So we thought of amending the complete guidance note per se. So you would be received already the emails, each and every members. The mass mailing has been done to all the members. We have also sent the request to various regional councils and the branches also. We have already started receiving responses. And we received a lot of responses generally to this guidance note on tax audit, because it has been always one of the most important publication, or I would say important guidance, which has been given by the institute to the members, which helps them in discharging their assurance functions very accurately. And I always request the members whenever I get a chance that please do follow our guidance note. Our guidance note is at very high pedestal. It is mandatory in nature. In case you are not following, you have to document that why you have not followed and what are the alternate audit procedures which have been followed. And therefore, my request to you is guidance note technically acts ring fence you. Supposing if you have been put to a question tomorrow that whether you have discharged your assurance function correctly or not, you can always rely upon the guidance note. Just take an example of definition of turnover for F&O. I know a lot of people may agree or may do not agree, but as I always say, whenever any standards on auditing or accounting, any guidance note are issued by ICI, please treat it as final. You may agree with not. If you have some different views, there is a time now. The exposure draft is open up till 20th of July. After that, each and every comments, I'm telling you again, repeating, any comment sent by you in the Google form or even through an email, my request would be a Google form. It becomes easy for compilation. Please do fill that Google form. Each and every request has been looked into by my office, by the committee, and by myself personally also. We have already, as I said, we have already started receiving comments. Already we have got a lot of comments also. Those comments received in last 4 days have been already dealt with it. Either they have been discussed or they have been already decided to be incorporated in the final version of the guidance note. So please do respond to that. Apart from this guidance note, the most important thing which we have been discussing was on income tax bill. Last time I did mention that income tax bill would be presented in the monsoon session. I believed I was under impression that it would start on 10 July earlier, but now I know it's been starting after 21st or 22nd of July monsoon session. In fact, last I got a news that out of the suggestions made in the amendments to be an income tax bill, which my office is working concurrently today, since yesterday, what are the changes which have been accepted by the board that yes, these changes should be incorporated in the version of the bill. More than 25 suggestions have been already accepted, but the verification is going on what they are accepting it. Balance which they have not accepted and they have given us a rationale. We are reviewing those. If we are satisfied, if the committee is satisfied with their rationale, we may not insist upon those changes in the income tax bill before it becomes an act. But yes, if we are not satisfied, we will re-represent it. So our one more suggestion may go to the select committee of Lok Sabha, maybe by today evening. So I thought I'll just give you a background of this too. Third, very important, as I mentioned earlier also, you may expect maybe in a week or maximum 10 days, a notification from the institute in regard to tax audit limit. You would have read President's message, but it has not been notified yet. Notification is in process. Yes, tax audit limit was 60 per member, but the signatures could have been more also. Supposing I am two partner firm, my eligible limit was 120. Any one partner out of two could have signed or generated 120 units. Starting 1st April 26, repeat 1st April 26. Yeah, I don't want to disturb this particular financial year because you would have already started your engagement. Starting 1st April 26 financial year, whatever audit engagement you are undertaking, whatever you are accepting, you cannot sign more than 60 also. So if you are a two partner firm or a three partner firm, your maximum eligible limit of undertaking a tax audit is 120. Each partner has to sign a 60 tax audit reports. We will also try to incorporate that restriction in the union portal also, that beyond 60 it cannot be generated, so you do not err on the wrong side of the law. That's what I thought I will update. So notification should come any point of time. You may please do look into it. And obviously, as I said earlier, this limits and this signing limits was decided based on the general public outreach, wherein we got more than 4,000 responses based on the Google form sent to each and every members. And we have considered all those suggestions, and thereafter the council has approved this. So these are the three important things which I thought I will update you. Fourth and last, we are trying to come out with a checklist. My vice chairman, who could not join, he's part of those groups. He's heading those groups. Mr. Vishnu Agarwal is working very strongly on that. I believe if I'm able to, by end of the July, at least come out with some checklist for certain ITRs. We know this year, even the utility is not there. Members are suffering. We have been talking to the CBDT. I've been told it should come shortly. But obviously, the extension has been given. Some people are raising questions whether the tax audit would also be extended or not. Of course, we do not have any clue today. But of course, better if you ask me personally, not as a chairman direct tax committee, I believe it should be extended today, because obviously when the income tax returns are being extended and you don't have any utility in place today, obviously CBDT would consider that. I've been told that there is some upgradation of system going on, and therefore this delay is happening. Fine, we'll live with it. If the systems are upgraded well, if the issues of the SSCs and the professionals are being resolved through new systems, and think so we will be happy for that. So with these four areas, obviously, once again, thank you very much, Sanjay Bhai, for moderating this session. Of course, I know as a regional council member, you yourself is too busy, but obviously today, this seminar has been watched across India. So you have people who are viewing you across India, and Prajapati ji, who is again an expert, who would be dealing with section 56 to 10, a huge controversy. And I always tell Prajapati Sahab, when I discuss being a tax litigator, I always tell that somebody asked me that what is the future of direct tax practice? And I always tell, till the sections like 56 to 10 or section 68, 69 is in the statute, I think so person who is litigating like me has nothing to worry. Another 10 years or 15 years at least will have a lot of work. I'm sure you will be bringing out all those issues for the benefit of members. Thank you very much once again to all the members. Over to you, Sanjay.
Thank you very much, Chajat sir, because we saw you since last term also and this term also. And this year is going to be a very important year for the direct tax practice, because direct tax bill is coming up. We have seen the scenario in 2018 when GST came, and similar scenario is we are expecting this year. And we are privileged and we are grateful to the institute that the leader like you is heading a direct tax committee at a vital time. I've seen you in the even income tax meetings also. The way you presented our suggestion to the select committee and other officials, we are very much in a safe hands. That a torch bearer of the direct tax committee is so engrossed and so intelligent and so expert in those topics. Choosing the right word at the right forum is a thing that we should learn from you. And thank you very much. In the short span of 5 minutes also, you try to cover the working you are doing. I know 5 minutes are not sufficient for telling the people that what ICA and direct tax committee is working. Still, we appreciate that notification. You spoke on the notification which is supposed to come very soon about the direct tax limit and 25 suggestions accepted by the select committee. Kudos to you, sir, and we appreciate the hard work done by you. Thank you very much for sparing time for the members, and we will follow your footsteps, and your guidance is very imperative for us. Thank you, sir. Now we will move on to the subject of the today's talk session, that we are going to have interaction with the expert MD Prajapati sir, very known personality in the fraternity, and he is going to deliberate his knowledge on the section 56 to 10. Friends, I would like to introduce him for the better understanding of the members. CA MD Prajapati is the past president of Malar Chamber of Tax Consultant for the year 2021, past chairman of Vapi branch of WRC of ICAI for the year 2015-16, and treasurer of Vapi branch for the year 14-15, treasurer of Rotary Club of Kandivali for the year 17-18. He is co-opted member of Student Committee of WRC for the year 21-22, CSR Committee of WRC for the year 16-17, and membership committee of the Chamber of Tax Consultants for 14-15 and 15-16. And these are only uh, the details about the committees he is heading. But as a WRC, as a regional council member, I have heard him in many sessions. He is regularly presenting his papers and knowledge at WRC and ICI at many occasions. So we have the privilege to have him to share his expertise and wisdom with us on the topic uh, integrities and issues related with the section 56 to 10. Sir, with these words, I open the forum for you. You can take the charge of the forum.
Thank you, Sanjay ji. Am I audible?
Yes, sir. One more thing I'd like to add. There are many questions members have raised. After you complete your session, we'll take the question answer session between 3:30 to 4.
Okay, sir. Yeah, there are so many issues even I have in my presentation, so we will require more time. Anyway, Direct Tax Committee Chairman CA Piyush Sajet ji, Vice Chairman Vishnu Agrawal ji in his absentia, CA Sanjay Nikam ji, Regional Council Member and moderator of today's webinar, respected members and dear friends. It's a great pleasure in presenting and discussing the issues, so many issues involved in section 56 to 10. Initially, I will start with the background of section 56.2, and then after maybe say half an hour or 45 minutes, we'll focus on the issues. I'll share my screen.
Ravi ji?
Yeah.
Technical support, please help sir to share his screen.
Yeah, we'll start. Members, you know that Gift Tax Act 1958 charged to taxation on gifts made by person to another person, with effect from 1st April 1958. White Clause 78 of the Finance Bill 1998, subsection 3 was sought to be inserted in section 3 of the Gift Tax Act 1958, provide that any gift made on or after 1st day of October 98 was not chargeable to tax under this act. So the Gift Tax Act was abolished in 1998. While moving the finance bill in Parliament, the Honorable Finance Minister Sri Yashwant Sinha ji, in para 99 of the budget speech, observed as under: Gift tax has been levied in India since 1958. The revenue yield from this tax has been insignificant. That time, he mentioned that 9 crores were barely collected by way of gift tax. The Gift Tax Act also not been successful as an instrument to curb tax evasion and avoidance. He therefore proposed to discontinue the levy of gift tax on gifts made after 30th September 1998. At the same time, to ensure that there are no leakages of income tax revenue through the mechanism of gifts, he said, I propose to tax the gifts under the Income Tax Act itself in the hands of recipients. However, the gifts from non-residents, including NRI, through banking channels, will continue to enjoy exemption as at present. However, when the Finance Number 2 Bill of 1998 became Finance Number 2 Act 1998, amendment proposed in Section 56 was dropped. But by Section 75 of Finance Number 2 Act 1998, the amendment proposed in Section 3 of the Gift Tax Act was carried out. As a result, gift made on or after 1/10/1998 were neither taxable under the Income Tax nor under the Gift Tax Act, as the Gift Tax Act was repealed that time. Then, so from 1st October 1998 till 1st September 2004, gifts were neither taxable as income nor as gift. While Finance Number 2 Act of 2004, the amendment was made in Section 56 by inserting Clause 5, therein to treat sum of money exceeding 25,000 rupees received without consideration by an individual or undivided family from any person on or after first day of September 2004 as income chargeable to tax, subject to certain exceptions. Para 102 of the budget speech of Honorable Finance Minister Mr. P. Chidambaram read as follows. Honorable members are aware that I abolished the Gift Tax Act in 1997. In fact, the Gift Tax Act was abolished by Yashwant Sinha ji in 1998, but he mentioned that he abolished. That decision remains, but a loophole requires to be plugged to prevent money laundering. Accordingly, purported gifts from unrelated persons above the threshold limit of 25,000 will now be taxed as income. Gifts received from blood relations, lineal ascendants, and lineal descendants. Gifts received on certain occasions like marriage will, however, continue to be totally exempt. The provisions of Section 56(2)(5) was in force from 1st September 2004 to 31st March 2006. This clause was replaced by Clause 6 of Section 56(2) by Finance Act 2006. This Clause 6 was in force from 1st April 2006 to 30th September 2009. Now, this Clause 6 was replaced by Clause 7 by Finance Number 2 Act 2009. A new Clause 7A was introduced by Finance Act 2010 with effect from 1st June 2010. These clauses were in force up to 31st March 2017. By replacing the Clause 7 and 7A of Section 56, Clause 56(2)(10) was inserted in Section 56 by Finance Act 2017 by the then Finance Minister Arun Jaitley. So from 2004 to 2017, there are so many changes in Section 56(2). It needs to be noted that since the receipts are capital in nature and sought to be taxed under income from other sources, correspondingly, Section 224 defining the income was also amended. The intention of the Parliament in replacing Clause 7A by Clause 10 in Section 56(2) can be gathered from the Honorable Finance Minister's speech in presenting the budget and memorandum explaining the proposal in the Finance Bill 2017. It is proposed to widen the scope of Section 56 of the Income Tax to provide that any money, immovable property, or specified movable property received without consideration or with adequate consideration by any person subject to certain exemption and exception shall be taxable of its value if its value exceeds rupees 50,000. So 25,000 has become 50,000. Under the existing provisions of Section 56(2)(7), a sum of money for any property which received without consideration or for inadequate consideration in excess of 50,000 by an individual or HUF is chargeable to tax in the hands of the recipient under the head income from other sources, subject to certain exceptions. Further, receipt of certain shares by a firm or a company in which the public are not substantially interested is also chargeable to income tax in case such receipt is in excess of 50,000 and is received without consideration or for inadequate consideration. The existing definition of property for the purpose of this section includes immovable property, jewelry, paintings, shares, etc. And the anti-abuse provisions are currently applicable only in case of individual or HUF and firm or company in certain cases. Therefore, the receipt of money or property without consideration or for inadequate consideration does not attract these anti-abuse provisions in case of other assessees. In order to prevent the practice of receiving the sum of money or the property without consideration or for inadequate consideration, it is proposed to insert clause 10 in subsection 2 of section 56 so as to provide that receipt of the sum money or the property by a person without consideration or for inadequate consideration in excess of 50,000 shall be chargeable to tax in the heads of the recipient under the head income from other sources. It is also proposed to widen the scope of existing exception by including the receipt by certain trusts or institutions and receipt by way of certain transfers not regarded as transfer under section 47. Consequential amendments were also proposed in section 49. So all these amendments will take effect from 1st April 2017, and the said receipt of sum of money or property on or after 1st April 2017 shall be chargeable to tax in accordance with the provisions proposed in subsection 10 of section 56(2). So, in nutshell, section 56, I will summarize. Section 56(2)(5) was operative from 1st September 2004 to 31st March 2006, and it was applicable only receipt by individual and HUF. 56, then the 56(2)(6) came into existence from 1st April 2006 to 30th September 2009. This was also applicable to individual and HUF only. Then 56(2)(7) came into existence from 1st October 2009 to 31st March 2017. 56(2)(7) and 56(2)(7)(a) both were operative up to 31st March 2017. Now, 56(2)(7) was applicable to individual and HUF. 56(2)(7)(a) was applicable to firm, company in which public are not substantially interested. 56(2)(10) came into existence from 1st April 2017 onwards, and it is applicable to any person. Type of transaction covered is received without consideration or for inadequate consideration. Post introduction of section 56(2)(10), the valuation rules, Rule 11U and 11UA, were also notified to determine the fair market value of properties, movable properties, for the purpose of taxation of receipt of immovable properties without or for inadequate consideration. The stamp duty value, that is SDV, is the basis. In section 56, to mitigate the hardship faced by the taxpayers in genuine cases, substitution of SDV by FMV, stamp duty value, is substituted by the fair market value, is permitted in certain cases by following certain procedures. Similar provisions are also incorporated in the respective clauses of section 56(2). Now, basis of section 56(2)(10). In order to effect the provisions of 56(2)(10), following are the requirements. The first requirement is, during the year, the assessee must have received sum of money without consideration, specified movable property without consideration, specified movable property for inadequate consideration, immovable property without consideration, immovable property for inadequate consideration. The aggregate value of benefit of each of the above. So each category, there is a limit of 50,000. First three, aggregate value of the benefit in each of the above mentioned first three categories: sum of money, movable property or without consideration, or movable property without for inadequate consideration. Three categories must exceed 50,000 per annum. In case the benefit of each of the above mentioned first three categories exceed 50,000 per annum, the whole of the such benefit would be taxable under the income from other sources. So this 50,000 limit is not a standard deduction. Like if it exceeds by even 1 rupee, entire amount is taxable. For the fourth and fifth categories, that is namely immovable property, the receipt of immovable properties being land or building or both, either without consideration or for inadequate consideration, the limit of 50,000 is to be applied qua property received. So immovable property, if more than one property are received, the limit of 50,000 will apply qua property. In case of receipt of immovable properties for inadequate consideration, taxability would arise only if the stamp duty value exceeds consideration by more than, now it is 10%, earlier it was 5%. Or 50,000, whichever is higher. In case where the SDVs, stamp duty value varies between the date of agreement and the date of registration of immovable property, and the consideration or part or full has been paid by way of account pay check, draft, or ECS through any banking transaction, banking mode. Before the date of agreement, the stamp duty value on the date of agreement shall be substituted for the stamp duty value on the date of registration of immovable property. In case the registration is deferred and any payment is paid by check by the buyer, purchaser, then the original date will prevail. The stamp duty value as on the date of booking or date of agreement will prevail. In case the stamp duty value is disputed by the assessee on the grounds mentioned in section 50C2, the procedure prescribed in section 56C2, rate based section 155 would be applied here also. In case that in case of receipt of certified movable property without consideration or for inadequate consideration, FMB has to be determined in accordance with Rule 11U and 11UA. Exception provided for receipt by or from certain type of persons. It may be pertinent to note that 5 categories mentioned above are independent and all of them are not required to be aggregated for the purpose of triggering taxation under section 56(2)(10). For example, Mr. A during the year has received cash gift of rupees 40,000, jewelry of rupees 45,000, purchased shares of 10 lakhs, the FMB of the said shares is say 10 lakh 48,000. Since the benefit received in each category does not exceed 50,000, the entire amount would not be taxable as income from other sources. Now the next is section 56(2) versus section 56(2)(7) and 7A. As noted from the memorandum explaining the provisions of finance bill, the provisions that existed up to March 31st March 2017 charged to tax the sum of money received without consideration or specified property received either without consideration or for inadequate consideration, only in respect of individual HUF firms and companies. The same did not apply to other type of businesses. Prior to 1/4/2017, a firm or company not being a company in which public are substantially interested, receiving shares of another company not being a company in which public are substantially interested, was alone liable for taxation under section 56(2)(7A). For these 2 types of assets only, one asset was specified, namely shares of company in which public are not substantially interested. Shares of listed companies, other securities of listed companies, immovable properties, jewelry, archaeological collections, paintings, etc. received either without consideration or for inadequate consideration by these 2 types of entities were not liable for taxation. Similarly, up to 31st March 2017, the SSC other than individual and HUF like AOP, body of individuals, LLP, company, firm, etc. receiving shares and securities of a listed or unlisted company or immovable properties either without consideration or for inadequate consideration was not liable for tax. Section 56(2)(10).
Prajapati sir.
Haji.
Sir, one request has some member has raised the request that your screen is frozen. We are presenting the presentation. Then, are there any slides?
Slides तो नहीं है sir. This is full.
Okay, no problem. No,
I'll complete this theoretical part in 10-15 minutes. Then we will come to the issues.
Okay, sir.
It will be making more interesting.
Okay, sir. Okay. Thank you, sir. Thank you.
Section 56(2)(10) seeks to tax the sum of money received without consideration or other specified properties received either without consideration or for inadequate consideration by any person from any person or persons except to the extent exceptions are provided in the said clause. As a result, in case of receipt of specified assets other on or after 1/4/2017, the status of the recipient would not make any difference in the taxability of such receipt. A person, in view of the above, on or after 1/4/2017, all the above type of persons receiving the sum of money without consideration or specified assets, either without consideration or for inadequate consideration, would be liable to tax under section 56(2)(10), subject to the exceptions provided therein. Now, the meaning of consideration is mentioned. Now, keeping the term consideration is used in several places in the Income Tax Act. However, the same is not defined in the Income Tax Act. The explanation to section 54(f)(1), the term net consideration is only defined. Section 2D of the Indian Contract Act defines consideration as when, at the desire of the promisor, the promisee or any other person has done or abstained from doing or does or abstains from doing or promises to do or to abstain from doing something, such act or abstaining or promise is called consideration for the promise. It is worth noting that the provisions of the Wealth Tax and Gift Tax Act contain the phrase consideration in money or money's worth. But in section 56(2), concise that is omitted in money or money's worth. The phrase used is consideration only. Keeping the above principles in mind, one needs to examine whether the amount received in following cases would hit section 56(2)(10). First, we will discuss this again in the question answer. Lump sum alimony received under a decree of divorce. Amount received by partner from the firm upon retirement or change in constitution. Compensation received before taking up the employment. Loan borrowed. Shares received by an employee under ESOP. Assets transferred by a fiancé to a fiancé on a promise to marry. Amount assets received upon family arrangement. Claim received from insurance companies on account of road or rail accidents. Amount received by hospitals toward patient's account in response to a public appeal. Gift received from parent company. Waiver of term loan, working capital loan. Requisition compensation paid by government before proceeding for the acquisition of the property. Forfeiture of share application money. All these issues we will discuss. Damages received for breach of development agreement. Interest subsidy. Payment by professional firm to the ex-partners and spouse of deceased partner. Compensation received for cancellation of auction even after payment of auction price fixed by DRF. Surplus resulting in assignment of loan to third party. Money received by an author for publishing the letter he received from another eminent author and preserved for several years. Section 43(2) defines the term paid to mean actually paid. So even in section 56(2), the money should be actually amount should be received. Now the next definition is sum of money. This is also, I'll skip, no need to. The next is immovable properties. Meaning of immovable property is defined in clause D of explanation to section 56(2)(7), and the same is applied for section 56(2)(10) as well. This definition is exhaustive and not illustrative, meaning the assets specified in clause D of the explanation alone would be chargeable to tax, and no other assets would be chargeable to tax under this clause. Further, the definition also states that the assets must be capital assets. One of the items found therein is immovable property, being land or building or both. So the assets which are capital assets will only be covered under section 56(2)(10). For example, agricultural land in a remote place which is not falling under the definition of capital asset will not be hit by section 56(2)(10). Any land or building or part of a building, and includes where any land or any building or part of building is to be transferred together with any machinery, plant, furniture, fittings, other things such machinery, plant, things are also. So immovable property means all these things. Any right or with respect to any land or any building or part of a building whether not including any machinery which has been constructed or which is to be constructed according to accruing or arising from any transaction by way of becoming a member or acquiring shares in a cooperative society, company, or other association of persons, or by way of agreement, or by an arrangement of whatever nature, not being a transaction by way of sale, exchange, or lease of such land, building, or part of building. So the phrase of immovable property has a wider meaning as compared to land or building, or both. Section 50C and 56(2) deal with only land or building, or both. Both these sections do not deal with any right or interest in the land and building. So leasehold rights or leasehold premises are not covered in this case. If one concludes that the provision of section 56(2) would not apply to the rights, interest in immovable properties, consequently, one may hold a view that acquiring these rights for a consideration less than its stamp duty value or without consideration would also not trigger provisions of section 56(2)(10). Next is in case of immovable property, if the amount is treated as income under section 56(2)(10), then that would qualify as a cost under section 49(4) of that, when the capital gain is computed while transferring such property subsequently. Next is now specified movable assets covered versus assets not covered. In section 56(2)(10), explanation D to section 56(2)(7), movable property means the following. So this is the exhaustive list: shares and securities, jewelry, archaeological collections, drawings, paintings, sculptures, any work of art, or bullion. In the definition of capitalization mentioned in section 214, personal effects are excluded. Following are excluded from personal effects: jewelry, archaeological collection, drawings, paintings, sculptures, any any work of art. From the above, it could be gathered that in addition to the excluded personal effects, only bullion and shares and securities are included in the list specified in movable properties for the purpose of section 56(2)(10). Section 56(2)(10) applies only to assets specified and not for any other assets. For example, if a motor car is given as a gift by unrelated person to the assessee, the same would not be liable to tax in the hands of the assessee because it is not a specified movable asset. When an assessee transferred the plant and machinery from his individual status to his HUF status for an amount which is less than the written down value of the plant and machinery, the asset under consideration is not a specified asset, and therefore provisions of section 56(2) would not apply. However, in the undernoted case, Honorable ITAT has held otherwise. If one holds a view that the list of specific assets given in clause D of the explanation is exhaustive, then one may need to examine whether the receipt of the following assets would not trigger the provisions of section 56(2). Undertaking or unit as a going concern under slum sale, interest in partnership firm, interest in LLP. So all these things will not trigger the provisions of section 56(2)(10). Now, interest in a partnership firm is not an interest in body corporate. However, interest in LLP can be said to be an interest in a body corporate. Also, one has to examine whether such an interest is freely transferable or marketable. If there are restrictions in the LLP deed, then it may not be considered as a marketable security in a body corporate. One will have to read the LLP deed before taking the decision. Interplay between section 50CA versus section 56(2). As per section 50CA, in case of transfer of shares of a company in which public are not substantially interested for a consideration less than FMV, the FMV shall be substituted over the actual consideration. In case of transfer of all other specified movable assets other than the shares in a company in which public are not substantially interested, held as capital asset by the transferor for consideration less than its FMV, the consideration actually received is not required to be substituted by its FMV. In case the specified movable assets are gifted, the same would not be liable to capital gain in view of the specific provisions contained in section 47. However, in the hands of recipient, when these specified assets are received as capital assets, either without consideration or for inadequate consideration, the provisions of section 56(2) would apply. So if the shares are transferred for inadequate consideration or without consideration, 50CA will not, but 56(2)(10) will trigger. If a partner gives the shares of a listed company held by him to the firm in which he is partner, then by virtue of section 47, the same would not be liable to tax in his hands. If the firm receives the said shares of the listed company as stock in trade, the provision of section 56(2) also would not apply to the firm. It may require mention that the treatment given by the transferor for a particular asset, say as a capital asset, does not compel the transferee to treat the same asset in the same manner. So if the transferor is treating that as a current asset, then transferor is, in case of transferor, it is a current asset, transferee can treat it as a capital asset. When a partner contributes the shares held by him in a company in which public are not substantially interested as his capital to the firm in which he is a partner, controversy could arise about the applicability of provision section 45(3) or section 50CE. However, in the hands of firm, fair market value test must be satisfied to avoid provisions of section 56(2)(10). Similarly, when the firm distributes the shares held by it in a company in which public are not substantially interested to its partners on account of dissolution or otherwise, a controversy could arise about the applicability of section 45(4) or section 50CE. Although the FMV is the basis for both the sections, the FMV is defined in section 2. FMV defined would apply for the former and FMV as per 11 UA would apply for the later. For partner who receives such shares, the FMV test under Rule 11 UA need to be satisfied in respect of amount recorded in the books of the firm. Withdrawing partner on account of withdrawal of shares of the company in which public are not substantially interested. Following are the transaction in connection with issue of shares, securities. It may pose some challenges. Shares subscribed in pursuance of the order of NCLT, where the FMV of the shares taken over after taking into account the sacrifice by the lender, creditor, etc., is more than the price for which the shares were subscribed. Shares are issued upon conversion of the bonds or debentures and on conversion and the conversion rate agreed upfront. Receipts of share securities or other specified assets by a shareholder upon reduction of capital. Issue of redeemable preference shares as bonus shares to the equity shareholders. Exceptions to provisions to section 56(2)(10) deal with the exceptional cases to which the said clause would not apply. There are totally 11 items in the proviso. The first item is a receipt from a relative. Now the definition of relative is there in my subsequent presentation. On the occasion of marriage, second is on the occasion of marriage. Third is by way of will, inheritance. Then in case of family settlement, by a private trust, reorganization related cases like amalgamation, partition of HUF, local authority or institutions, the question now arises whether the member receives from an HUF any amount or asset, whether the transaction would fall under section 56(2)(10) or it would be exempt under section 10(2). We will discuss this in our question answer. Any amount or specified asset received by an HUF from the relative of Karta would not qualify for exemption. Now, on the occasion of marriage, next exception is about the receipt of, on the occasion of marriage of the individual. This exception would apply only in relation to the individual and not for HUF. So this gift received on the occasion of marriage this exception will apply to the individual only. Further, the receipt by the bride or groom would alone qualify for the benefit and not the receipt by parent of the bride or groom. So parents cannot receive gifts on the occasion of marriage of their children. The term on the occasion of marriage has wider meaning as compared to at the time of marriage. Therefore, any amount property received few days prior to or after marriage will also qualify as receipts on the occasion of marriage. The amount on the occasion of marriage need not be received from relative. It can be received from anyone. Will inheritance in contemplation of death of donor. Any item received under will or by way of inheritance is not subject to 56(2)(10). Another item in respect of contemplation of death of payer or donor. To fall under this clause, the payer must be ill at the time of giving the money. Specified asset and possession of the asset must have been handed over to the recipient during the lifetime of the donor. There is an interplay between section 68 and section 56(2). In the above 4 categories like this, will, inheritance, marriage, in order to claim the benefit, the test of genuineness has to be satisfied. If the test of genuineness falls, the receipt may become taxable under section 68. See, 56(2)(10) may not trigger, but if the transaction is not genuine, then it can be taxable under the section 68, 69. Merely because the claim falls under any of the above mentioned 4 categories, one may not be in a position to say that the test to be satisfied under section 68, 69 can be dispensed with. In other words, the first test to be satisfied is under section 68, 69 series, and thereafter the exception provided in section 56(2)(10) should be applied. In case where the assessee satisfied the conditions of section 68 and thereafter provided that the amount received is from a relative, the AO cannot make addition of such sum to the income of the assessee for the reason that the assessee could not furnish the details of the amount received. The next series of exceptions are receipts from local authority as defined in section 1020, fund or trust, institution or medical or educational institution referred in section 1023C, 12A, or institution registered under 12A, 12AA. So all these institution funds are not subject to section 56(2)(10). It is separately covered under the different sections of the trust. Since there is specific provision providing exception in case of trust or institution recognized under 1023CA, 12A, question arises about the applicability of section in case of trust not registered under 12A, not recognized under 1023. Needless to say, the income of this unregistered institution would otherwise be chargeable to tax under normal provisions. However, one has to examine the applicability of the provisions on the corpus donation received by this unregistered trust. Even when the section was applicable only to an individual or HUF, the judicial decisions were to the effect that corpus donation received by an unregistered trust would not be liable to tax because they are capital receipts. The ratio of this decision need not be tested in the light of amendment made in section 56(2) by making this section applicable to AOP, VOIN as well. Reorganization related cases. Since the scope of 56(2)(10) has been enlarged to include companies irrespective of whether they are listed, unlisted, public or private, and all other type of entities, exceptions have been provided for the following transaction. 47(1) section, 47(4) distribution on total or partial partition of HUF, 47(4) by holding company to its 100% subsidiary company, 47(6) by subsidiary company to its 100% holding company. In case of amalgamation, 47(6)(a) transfer of shares of Indian company held by foreign company to another foreign company in a scheme of amalgamation, transfer of capital asset by banking company with a banking institution in a scheme of amalgamation, transfer of capital assets by a demerged company to the resulting company. So all these are not covered under section 56(2)10. Transfer of shares in an Indian company held by a foreign demerged company, transfer of capital assets by a predecessor cooperative bank to the successor cooperative bank, transfer of shares held in a predecessor cooperative bank in lieu of allotment of shares in successor cooperative bank, transfer of shares in the amalgamated company in lieu of shares in amalgamated company. Also, the exception is provided only for tax neutral amalgamation, satisfying the condition of section 2(1)(b) of the Act. For example, conversion of company into LLP, that will also not trigger section 56(2)10, provided the conditions of that section 247(13) is complied with. Now, this valuation of specified assets, valuation of artwork, etc. In case of archaeological collections, drawings, paintings, sculptures, or any work of art, the FMV shall be determined as follows. The invoice value of the artwork is purchased from a registered dealer. The value mentioned in the valuation report obtained from the registered valuer. In case the artwork, etc., are obtained in any other mode, such requirement of obtaining the valuation report from the registered valuer would arise only if the value of the specified assets exceeds 50,000. Valuation of jewelry. In case of jewelry, FMV fair market value shall be determined as follows. Invoice value of the, if the same is purchased from a registered dealer, the value mentioned in the valuation report obtained from the registered valuer in case the jewelry are obtained in any other mode. Such a requirement of obtaining the valuation report from the registered valuer would arise only if the value of the jewelry obtained exceeds 50,000. Quoted shares and security. In case of quoted shares and securities, it shall be determined as follows. The value shall be transaction value as recorded in the stock exchange if they are received by way of transaction carried out through recognized stock exchange. Lowest price of such shares and securities quoted in stock exchange if they are received otherwise than by way of transaction carried out through a recognized stock exchange. Unquoted shares. In case of unquoted shares and securities, the rule divides them into unquoted equity shares, unquoted preference shares, and securities. In case of unquoted preference shares and securities, the estimated price it would fetch if it is sold in the open market value, as on the valuation date, supported by the report of merchant banker or a chartered accountant, shall be the FMV value. In case of unquoted equity shares, the rule provides for valuation based on the balance sheet on the valuation date, audited by auditor appointed under the Companies Act. Transaction in the unquoted equity shares may take place on different dates in a particular financial year. Expecting the recipient of the unquoted shares of the company to have the audited balance sheet of the company on the date of receipt of the shares of the company is near impossible. Therefore, the exercise of ascertaining the value of the shares as per the last audited balance sheet and factoring the same for the profit earned by the company from the beginning of the year till the date of receipt of the shares by the recipient was accepted. The value appearing in the balance sheet of the company for the following assets requires substitution of the value prescribed: jewelry and artwork, immovable property, the stamp duty value of the immovable property, assets adopted for assessable. Substitution of the FMV of the specified asset while determining FMV of the shares, unquoted equity shares of the company would become onerous task to the recipient when the company's balance sheet contained number of assets falling under the above mentioned category. Task would become all more difficult when there is wide fluctuation in the above mentioned asset portfolio between the last audited balance sheet and the valuation date. In case the company invested in shares and security of another company, the FMV of such shares and securities must first be determined. Thereafter, the FMV of the shares of the company under transfer must be determined. As per Rule 11U, listed securities means security listed in a stock exchange in India. In other words, the securities of a foreign company listed in a foreign stock exchange also would be considered as an unquoted equity securities. Now, applicability of section to non-resident. After this, we will then take the controversies. As per the provisions of section 5, in case of non-resident, income received or deemed to be received in India or accrued or arisen or deemed to accrue or arise in India alone would be taxable under the Act. In case of non-resident, if the sum of money is received in India without consideration or specified assets are received in India either without consideration or for inadequate consider, same shall be liable to tax subject to the exception provided in section 56(2)(10). If the non-resident receives sum of money or specified assets outside India, unless the same is deemed to be received or accrued or arisen in India, the same shall not be liable to tax under section 56(2)(10). So for NRI to trigger section 56(2)(10), the NRI must receive the money. It must be deemed to accrue or arise in India. Otherwise, it will not be taxable. Now to ensure that the gifts made by residents to persons outside India are subject to tax, it is proposed to provide that income of the nature referred to in subclause 17A of clause 24 of section 2 arising from any sum of money paid or any property situated in India transferred on or after 5th July 2019 by a person resident in India to a person resident outside India shall be deemed to accrue or arise in India. However, in the existing provision for exempting gifts as provided in proviso to clause 10 of subsection 2 of section 56 will continue to apply for such gifts deemed to accrue or arise in India. From the so now the conclusion is section 56(2)(10) is a deeming provision and also anti-abuse provision. Therefore, strict interpretation is warranted while dealing with the provision. Legislature cannot anticipate all possibilities, eventualities while introducing the law, and the law has to mature over a period of time. More than 2077, 8 years have passed, and so many intricacies, so many controversies are there in section 56(2)(10). Members may feel that, in fact, Gift Tax Act was better. But it is good for professionals. You will have a litigation practice, as our chairman sir has mentioned in his opening remark. Similar is the case of section 56(2)(10). Situation like auction sale, distress sale, market command over smaller plot as against larger plot, locational advantage, disadvantage, encumbrances, impediment in transfer of assets, etc. Such exceptions are not provided for in determining fair market value, except for resort to a valuation officer in case of immovable properties, or by a registered valuer in case of specified movable properties. It may be apt to mention that the judiciary of the country, being fourth pillar, can alone come to the rescue of the taxpayer in case the provisions of the Act read with the rules do not provide remedy to the taxpayer in genuine cases. So there are genuine cases when certain properties having locational disadvantage, some other due to the lesser facilities, amenities, and because proximity from the main entry port near the cremation, all that cases. But section 56(2)(10) does not provide exceptions for such type of situations. Now, Sanjay ji, we can take the issues, or I will pose my.
Hello, sir.
Can we take the issues, or I have listed.
You start with one query from your side. Let me gather the queries.
You
Give
can
me
gather.
5 minutes. I'll ready with the queries, then I'll get back.
Meanwhile, Even
If you have case study, you go ahead
participants
with.
can also give their opinion, their comments.
Pardon, sir?
These are the questions. We can take their view also.
I don't know whether we can
Yes, sir.
invite
Okay.
them on the forum,
Now
but
so
they have
should I
already
start or
posted. There are many forums they have posted.
we'll wait for a few minutes, or should we start with the case studies?
If you have anything to say, sir, we can go ahead with your submission. Otherwise, we'll start with the queries.
Okay. Now the first is Mr. Lakshman is the owner of 5-acre agricultural land. He sold the same to Raman for 2 crore. 5-acre land he has sold for 2 acre, whereas the circle rate, that is stamp duty value, is 2.5 crore. What is the impact of section 56 to 10 and 50C in hand of both the assessees? Now, in this case, my answer is, my answer is impact of section 56 is nil, because the subject asset is a rural agricultural land which is excluded from the definition of capital assets under section 214. Similarly, the rigor of section 56 to 10 is also not attracted in case the buyer, because the subject asset does not qualify to be a capital asset. There is a exhaustive list given for triggering section 56 to 10. Next question is taxation of donations by individual. Supposing a poor person who is hospitalized, he appeals to the friends, relatives, and other institutions for the treatment of his medical treatment, and many unknown members, well-wishers, friends, relatives, do all online payment directly to the hospital or to his account, and then he pays to the hospital for his medical treatment. In such situation also, this will not be a gift under section 56 to 10, because this is just to meet his medical expenses. Now the third question is non-relative gift shares to HUF for rupees 5 lakh in financial year 23-24. The HUF sells the same shares in the same year for rupees 5 lakh. The original cost of shares was rupees 10,000 only. The holding period of the donor was more than 2 years. What will be the income tax implications on gift received? Since the shares are received from non-relative, it will be taxable, and it will be a cost, and the same is sold for 5 lakhs, so there will be no capital gain. Gift received by HUF from its non-relative, it's an income. Mr. A has given loan of rupees 5 lakhs to Mr. B, non-relative, and interest is charged. Later, after 2 years, the loan is waived. This will be a taxable gift in the year of waiver. But however, if Mr. A has taken the loan from bank for working capital or term loan, and if he has done a one-time settlement and bank waives interest or some overdue interest and some principal amount, in that case there is a consideration for the settlement. So that will not be taxable under 56 to 10. But this being a unsecured loan taken and then later on it is waived, so in the year of waiver it will be a gift. Now whether fixed deposit and NSC KVP received as gift from non-relative is covered under section 56 to 10. This is a tricky. The expression property as defined in section 56 to 10 does not specifically include fixed deposit, necessary certificate, KVP, etc. However, it could be considered any sum of money. Usme any sum of money received for without consideration or inadequate consideration. So if that is taken, then it will section 56 to 10 will apply. So Although in the specified movable assets, fixed deposit NSC is not mentioned, but it can, the assessing officer will include this in the definition of any sum of money received and tax this type of receipts. Taxation of gifts received from person who ceases to be a relative on the date of receipt of gift. For example, Mrs. X received gift from Mr. A, her brother-in-law, husband's brother, of rupees 1 lakh. Whether this is taxable, Mr. A, on the date of receipt of gift, Mrs. X is divorcee. So, on the date of receipt of gift, the relation has ceased. She is a divorcee, so this 1 lakh will be taxable in the hands of Mrs. X. Mr. A desires to give 1 lakh to his uncle, Mr. B. To his uncle, Mr. B. Mr. B is a nephew. Mr. A is not relative. So, in the definition of relative, I'll read the definition of relative. Nephew cannot give to uncle, but uncle can give to nephew. For the purpose of this clause, relative means spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of the parents of the individual, any lineal ascendant or descendant of the individual, any lineal ascendant or descendant of the spouse of the individual, spouse of the persons referred to above clause 2 to 6. So in this case, if A desires to gift 1 lakh to his uncle B, it will be taxable. But smartly, what Mr. Nephew is doing is Mr. A is not related. To overcome this problem, nephew is gifting to his father, Mr. C, who in turn gives to Mr. B, his brother. So, beta can give to son can give to father, and then father is giving to his brother. So that is allowed. This can be, so 56 to 10 can be overcome by doing this planning. But if the amount is big, GAR provision can apply. Where the assessee received a new flat in lieu of old flat surrendered under a redevelopment agreement, the transaction would not be regarded as receipt of immovable property for inadequate consideration for the purpose of section 56 to 10. There is a judgment of Mumbai Tribunal, Anil D. Pitale, 173 taxman 51. Here there is a consideration as per the development agreement with the developer. The original member surrenders his flat, and because he is sacrificing his hardship and all that, and he's sacrificing his rights, in that exchange he is receiving the new flat. So you can one cannot say that it is received without consideration or inadequate consideration. So this is not covered under section 56 to 10. Flat received as a compensation on redevelopment, compensation received as a court settlement to remove the nuisance of illegal occupant to be treated as capital asset. So in this case also, even if the tenant was illegal and he was occupying, he was creating nuisance, matter went up to the court finally settled it, and then the builder has allotted him the flat, and that flat was AOS disallowed, but finally the tribunal has given the relief and it was treated as a capital asset. 56 to 10 was not triggered. In case of family settlement also, there is an agreement among the family members to settle the dispute. They enter into an agreement, and there is a sacrifice. One member sacrifices the one thing, another sacrifices the other thing. In that case also, there is no 56 to 10 will not. In case of buyback of shares is now taxable. Earlier also it was taxable. So buyback of shares 56 to 10 will not apply. Issue of right shares or bonus shares also 56 to 10 will not apply. But if the right shares are renounced by the original holder within the family to a relative, then 56 to 10 will not apply, but if it is renounced to, if he renounced rights issued to the outsider, non-relative, then the recipient will pay tax as per the valuation of that rights entitled. Conversion of company to LLP, I told you if that 247(13) conditions are complied, then conversion of company to LLP will not fall under this. Assignment of interest by one partner to another partner or change in profit sharing ratio, retirement, dissolution, all this is interest in the firm is not a asset defined in the section 56 to 10, so it will not apply. Gift received by HUF from the member is exempt. Gift given by HUF to members is, there are controversial judgments. Rajkot Tribunal and then Chennai Tribunal. There are controversial judgments. One will have to share the citation. Yeah. Gift given by HUF to members relying on the decision of Chennai Tribunal in Vani Estate Private Limited versus ITD 624. Receipts by members from HUF is not taxable, not covered under section 56(2). And similar decision is also taken by Rajkot Tribunal. I have this citation. Chennai Tribunal in Vani Estates Private Limited 172 ITD 629. That there it is, tribunal has taken a view that an HUF consists of relative only, and the receipt by a member from the HUF is not covered under section 56 to 10. Similar view is similar decision is taken in case of Rajkot Tribunal. Rajkot Tribunal in a Vinit Kumar Raghavji by Balodia 2011 12 ITR 616 Rajkot Tribunal by declaring the issue under 56 to 7 held that receipt by a member from its HUF of subsidiary property is not taxable under section 56 to. Subsidy received from government by an individual is also not income. Property received by associate from his stepsister. In the definition of stepsisters, stepbrother are relative, so this will also not be taxable. Consideration received for shares in excess of fair market value on renunciation of rights. I told you, if the renunciation of right shares by wife and father in favor of assessee, that is exempt. But if it is renounced to a third party, then it will be taxable. Receipt by NRI. If NRI receives receipt by NRI, in case of NRI or non-resident or a foreign company or others, taxability of income under section 56 to 10 shall be subject to provision of treaty, wherever treaty is applicable. However, same shall be considered as taxable in India only if it accrues or is deemed to accrue or arise in India. Indemnity receipt. Generally, that there is an agreement in case of dispute, indemnity bond is created, and that is agreement, and if that is breached by either of the party, some compensation is paid. So it is part of that contract that will not fall under this. It may fall under a business or other right. Awards and scholarship again not taxable. Corporate restructuring, I informed in my, I already mentioned in my presentation. Corporate restructuring, that is merger, demerger, amalgamation. It is as per the scheme approved by NCLT or other institution, which will not fall under 56 to 10. Dissolution or retirement of partner, interest in the firm, this will not, 56 to 10 will not apply. Other section 45, 3, 4 depends. Is section 56 to 10 and 50 CA applicable when unquoted shares held stock in trade and transferred for inadequate consideration? This will not, because 50 CA will applies only in case of capital asset. Yeah, Sanjay ji, now we can take up the issues raised by members.
Yes, yes,
These were-
yes.
I
And
have tried my
let
best
me
to
tell you, sir,
whatever I could.
this section is not a simple section, and it covers complete and multi-angle questions are coming.
Hmm.
And you actually you presented your presentation in wonderful way, but still there are a number of questions raised by the members, and that shows members are engrossed with the
Yeah,
session.
this topic, this section is so
Yes,
litigated.
vast, and
Vast,
it is
vast. There is no
touching
end to
every
it.
facet. Uh,
Entire
so,
gift
sir,
tax
we'll
act
start
is
with the
in one section only.
Of course. This is
Yeah.
not a one section. It covers a lot of things.
Entire act.
Every transaction is connected with this above 50,000,
Hmm.
and there may be number of questions from the department also.
Yeah.
So, sir, we start with the questions. We have we'll check whether we have the time. Till 4, as much as possible, we will cover the questions. We'll start with the first question from Venkata Raghavendra. The question is, as per provision to 56 to 10b, if SRO value as on the date of agreement for fixing the consideration and date of registration is not sent, date of agreement may be taken. Can oral agreement fit into this? How can this be proved except the payment through banking channels made before execution of sale deed?
If the transaction is through banking channel, then only they consider that earlier date. That is specified in the section.
And the
What is the
question
date
whether
of date of original transaction?
that date is not mentioned here, sir.
Okay. But if it is a cash transaction, then it will be difficult. Only check transactions only are recognized.
Okay.
So there can't be.
Yes, sir. One thing, can oral agreement fit into this?
Haji?
Can oral agreement fit into this?
Oral agreement, no, because he has to prove the transaction, na? So some bank transaction has letter of allotment or some letter of intent, something in writing to prove that date valuation as on that date. Some evidence will be required.
Okay. The next question is from Nikhil Thakkar or Nagpur. Purchase flat with intention to sell, held as stock in trade in balance sheet. Can it be out of purview of section 56 to 10?
But
Flat is purchased with the intention to sell. It is a commercial property.
is there any difference in the stamp duty value and the agreement value? Beyond 10% fluctuation allowed?
It is not mentioned there, but I think the question is read under section context of the section 56 to 10. There must be a difference in value.
For 50 CA capital asset, but 56 to 10, even if you are holding as a current asset, still if there is a difference between the market value and circle rate, stamp duty value and agreement value 10% से ज़्यादा difference है, then you can't get rid of it.
Other sections will come into play.
Yes.
So his question whether 56 to 10 covers this transaction.
Yes, it will cover, sir.
Okay. The next question is from Kailash Chandra Singhal Silvasa. Buyer purchase agricultural land in rural area below 20% of the stamp duty rates for such rural agricultural land. Whether the transaction is covered under 56 to 10?
No, sir. In my first question, I mentioned there is a case law also. It will not, because the rural agricultural land is not a capital asset.
Right.
Mubarak Ghaffar Korabeli versus ITO 752 Pune Tribunal and Premchand Jain ACIT 183 ITD Jaipur Tribunal both have covered this. Even Ahmedabad Tribunal single sir has shared one judgment to me. There also it is covered. 56 to 10 will not apply to agriculture. Even 50 CA will not.
Right, agricultural land. So we'll take up our next question, sir. Narayan Murthy Vaidyanathan from Mysore. Is premium received on shares taxable under 56 to 10 post 1st April 2025?
2000?
25 means 1st April, this current year, this fiscal year.
I have
If
not.
premium received on share, premium is received on share taxable under section 56 to 10 post 1/4/25.
Yeah,
Current fiscal year.
There is an amendment in this. Now this premium, this is of unquoted shares. Which type of shares?
It is not mentioned. We can talk about the unlisted and listed, both of them. What will be the scenario? It is not specifically mentioned in the question. But
I can't. Question is not proper. Incomplete, I think.
If we suppose it is listed,
then
what? And if it is not listed, what would be the scenario?
If it is a listed share, then the value as per the market, at that rate it should be transferred. If it is taken more, then it will be capital gain will apply. If it is transferred for inadequate less than or inadequate consideration, 56 to 10 will apply.
Okay. Okay. What question is from Satyaram Rao, Sai Ram Rao? Is it required to disclose gift received from relatives or non-relatives less than 50K in ITR, as there are no specific schedule for disclosure? Non-disclosure should not create any issue.
We should, I think we are mentioning in the exempt income. You should disclose.
Yes. But it is, since it is less than 50K.
You should disclose so that later on, if the case is reopened or subsequent source of capital is to be proved, then disclosure will help.
His additional question, whereas few have suggested that disclosure under exempt income schedule, is it correct disclosure that you already said exemption schedule may have disclosed kar do? I understand that tax authorities have issued notices in both the situation on disclosure as well as non-disclosure. Request you to clarify and correct what is the correct position.
Sanjay ji, you only answer. What are you?
It is better to disclose.
I am advising my clients to do. It is better to disclose.
Yes, I agree
if
with
amount is received less than 50,000, which is exempt, it's better to disclose. Then why notices will come.
Even if notice arrives, we can show we have already disclosed.
And it will also prove the source, person who has donated, who has gifted, identity and genuineness of the transaction can be proved if it is already disclosed in the return of income.
So next question is from Akshay Kumar Garg from New Delhi. This question has 6 sub-questions.
Oh.
I'll take one by one. Can HUF give to its karta?
Give to karta.
Can HUF give to its karta?
Yes.
Okay. Can HUF give to its member other than karta?
Both. I have covered in my issues also.
Yes. Question 3. Is there any monetary restriction for the gift of money or immovable property? I think it is to karta or HUF only, between HUF. Is there monetary restriction?
No monetary. No monetary limit.
Okay. Further, question 4. Can HUF transfer its movable property to its karta only, specifically to karta? Transfer. He is saying transfer.
HUF will sell or only gift?
Transfer. See, initially the gift was covered by your answer. Now he is talking about the transfer. Might be a transfer under consideration or any other mode of transfer.
HUF can sell, but without the transfer, what about the other members? Other members should agree.
So that transaction, if they agree, that this kind of transaction is permitted.
Permitted.
If he is buying from his own sources,
Hmm.
then it's a arm's length. If it is arm's length transaction,
Hmm.
it is permitted.
Yes.
Question 5.
This is
Can
my view,
HUF
sir.
transfer?
This is my view. Other view may be possible.
Other view
view.
may be possible. Definitely. Can a HUF gift? This is very important question, sir. Can a HUF gift in the following circumstances? HUF's income is 1 lakh and wants to gift rupees 2 lakhs.
To give, HUF wants to give 2 lakhs to?
Can HUF give to his
Anybody,
member
na?
or
Other
other?
than the members of HUF, na?
Yes.
हाँ तो कर सकता है, but the recipient will be taxed under 56(2)(10) because amount is exceeding 50,000.
Whether he can gift more than its income. HUF can gift more than its income.
Out of its past capital and savings.
Reserves.
Yeah, if he has a own source and capital, HUF can gift, but the recipient will be taxed. If he is a
And
non-relative.
if HUF is gifting to its member, then
There to
it is
we have a tribunal judgment. It is not taxable. It is not taxable.
yes.
I cited.
Okay. So next question, Tapat Jyoti Sarkar from Navi Mumbai. Mr. A retired from service and deposited his provident fund withdrawals in fixed deposit account in the name of his wife to provide a source of earning to wife from interest generated therefrom. The wife will pay tax as per the maximum marginal rate pertaining to the interest of FD duly. Kindly clarify that the first instance of such transfer will not be taxable in the hands of wife or the transferor.
सर ये तो हस्बैंड वाइफ तो रिलेटिव डेफिनेशन में आएगा 56(2)(10) का को नहीं है प्रॉब्लम, बट क्लबिंग प्रोविजन विल अप्लाई. इनकम अर्नड आउट ऑफ दैट मनी विल बी क्लब्ड इन द इनकम ऑफ हस्बैंड. 64 will apply.
His question, as far as I understood, whatever income generated on FD, it will be clubbed out.
The income of husband. Will be the income of husband.
First one, because he has gifted without consideration, and
Correct.
that clubbing of income is applicable, but the amount of a provident fund he deposited in her name, whether that transaction will attract the taxation because that amount is gift to wife.
But no, sir. Husband wife is in the
relative.
But whatever she will earn out of that gifted amount will be the income of husband. Clubbing provision will apply.
Clubbing will apply. Sir, one question from Rahman Wakasur from Jamshedpur. Fair market value as mentioned in section 56(2)(10) of the Act itself is very contradicting matter. AO considers SDV as FMV, and intention of the state behind the ascertainment of SDV is to collect handsome amount of stamp duty, not to reach at the fair market value. Some state enhance the SDV every year and some in 10 years. In nutshell, taxation under section 56(2)(10) is grossly dependent on the policy of the state. How the uniformity be achieved in this section?
Right to the finance minister. Because yes, हर एक स्टेट का अलग अलग रूल है साहब, स्टैम्प ड्यूटी सर्कल रेट का.
I said I accept the owners.
We are helpless. In case if you feel that the market value of the property is much lesser than this circle rate, refer the matter to the DVO department.
Adjudication is also available with the stamp duty officer for valuation. Adjudication mechanism is also available, no, sir?
Adjudication, in stamp duty also you can adjudicate. Yes, you can. Of course.
And one more thing.
You know the subject better than me, Sanjay ji. You know the question.
We all are expert in some at some level.
Yes.
Every chartered accountant.
We are always learning. We are always learning.
Also are expert in their field. In my opinion, as a regional council member sitting here and as a directors committee chairman at WRC and the officials at the Directors Committee ICI.
Hmm.
In such scenario, it is onus on us also to represent such matters to the tax authorities.
Hmm.
And Rahman sir, we will appreciate your efforts if you can write a memorandum and if you can forward it to WRC or I think Jamshedpur to your regional council or ICI, will make attempt to forward it to the institute after proper vetting and after adding different points to it. So that way you also can contribute to the.
Yes, sir. Better. This will be a better representation.
Yes, sir. Yes, sir. We welcome all the views from the members. One more question I'll take, sir. Naran Murthy Vaidyanathan from Mysore. His question is: would partition of joint family property be hit by the? He has used the word, sir. I'm just reading. Mischief of Section 56(2)(10). Would family arrangement be construed as part of partition of joint family property? And whether family arrangements be hit by the above section?
No, family arrangement, there is an exception provided in the section. Family arrangement is, if it is properly arranged and properly documented, it will be accepted. So there will be, all the members will be involved. Someone will benefit, someone will sacrifice. Overall, for the harmony and peace of the family, that arrangement is done.
Right. Sir, Om Prakash Agarwal ji from Kolkata is writing one question, and this question is very relevant to every transaction so far as Indian scenario is concerned. Because we have a system of buying property in husband-wife name, joint names, and normally wife is a housewife.
Yes.
So this question is very relevant, sir. If one purchase property which is registered in joint names of himself and his wife, but whole consideration is paid by the husband, whether 56(2)(10) is applicable.
No, sir. In that case, wife's name is added out of the love and affection and for the convenience. She has not contributed. She doesn't become the, I think, co-owner. There are judgments. Generally, we add her name for the convenience and for safety. So that in case of any mishap, she doesn't have to struggle more to add her name to get the property transferred in her name and all that.
Yeah, and normally, sir, we are getting notices for this because TDS is deducted and agreement.
If she has not contributed anything, then she need not deduct TDS. Only first holder will. The person who has paid the consideration should only deduct the TDS.
Such matters are selected for the scrutiny, but as per my experience, if we in first submission only, if we explain the case with the factual data, in many cases they have dropped the cases, or in many cases they have come out with a zero addition.
Yeah.
We need to explain. This is a peculiar nature of our economy and our system.
Correct.
Sir, Rahul Baradia from Jabalpur is writing question. Settler is a father individual. Trustees are his 5 sons. Whether money given rupees 50 lakhs by sons as gift to the private trust shall be taxable as per section 56(2)(10). Explanation 10. Beneficiaries are grandsons and their wife plus children. Please guide considering that gift that will be received for the benefit of children of all brothers, whether benefit of relative definition can be argued.
Father has created a trust, right, for the benefit of grandchildren.
Yes. Trustees are 5 sons.
So there is no transfer, no?
Yes.
Transfer for the benefit of the next generation. Trust is created. So it will not come. 56(2)(10) will not come.
Fine.
और कुछ?
हाँ सर, बहुत सारे क्वेश्चन है सर. ये सेक्शन इतना इजी नहीं है. Narayan Murthy Vaidyanathan again has posted one more question. Fully convertible debentures of 30 each were issued in the year 2011. The equity shares having a face value of ₹10 each were to be converted into shares in the year 2014 at a premium of 20 each.
Hmm.
The FMV of the equity shares in the year 2014 was rupees 68 per share.
Hmm.
Whether the difference of rupees 48, that is 68 less 20,
Hmm.
can be taxed under section 56 to 10.
No, sir, it will be capital gain, na? Transfer.
Will be,
56 to 10 will.
so it will be taxed under capital gain, not under section 56 to 10.
Ah,
Right, sir?
yes, sir. This is my and your view matches.
Yeah,
Hmm.
it is
Yeah.
our both of us agreeing to this.
Hmm.
There may be different view
Yeah.
because this is very crisp question. There may be some other angles
Hmm.
to this question.
But this
and
has got
if we-
nothing to do with 56 to 10.
Yeah, it is capital gain valuation. One more question from C. Jatin Goyal. Good afternoon, sir. The definition of relative is given in the Income Tax Act,
Hmm.
as per which member is relative of HUF.
Hmm.
That is, any gift received by HUF from member is exempt.
Yes, sir.
My question is whether the gift received by the member from HUF is treated as a non-taxable gift, or is there any other section which exempt this type of transactions? One of my client has to transfer assets from HUF to members. Is there any way we can plan for non-payment of tax? I pardon, sir. We can't use this word plan non-payment of tax. We should write whether there is any legal provision whereby we can save the tax legitimately. Sir,
HUF can give to its members and HUF can receive from members. Both are covered in 56 to 10, sir.
okay, sir.
Hmm.
Sir, there are a few questions,
Hmm.
and we have for 15 minutes to.
Yeah, we have 10 minutes only.
Yes. So much as possible.
So transfer of property by HUF to members on partition or otherwise. Both are covered.
Covered.
Hmm.
So exempt. Those are exempt. Can
Yes.
I take next question, sir?
Yeah. Tell me. Yes, sir.
Arun Kumar Arora from Amritsar.
Hmm.
His question is: agreement is written on 20 December 2024 for purchase of land
Hmm.
for consideration of rupees 90 lakhs.
Hmm.
The recital in the agreement is that a sum of 30 lakhs
Hmm.
has already been given by check dated 30th October 2024.
Hmm.
This check has actually been cleared on 26 December 24
Hmm.
as seller deposited the same late.
Hmm.
The circle rate of property is rupees 1 crore at present. Circle rate on date of agreement is rupees 90 lakhs. Stamp papers will be purchased for the circle rate of rupees 1 crore, whereas consideration pass will be 90 lakhs. Kindly advise about taxability under section 56.
The rate of October and December, within 2 months there is appreciation by 10 lakhs.
Yes.
And 10% will also not help because 90 lakhs, 10% will add 99 lakhs.
9 lakhs.
But then the agreement is 1%. See, since the check was not deposited in October, it will be difficult scenario. Pellet level will appear. It
Okay.
will be difficult to prove that the transaction took place in October, unless he has an allotment letter or receipt dated October. If he has got the receipt, though the builder has deposited check later, but if he has the receipt of October date, then he can try his luck.
Right, sir. That depends on the agreement date also and the corroborative evidences. Whether
Evidence,
that
some
clear-
receipt,
clear.
allotment letter of
Yes,
October
yes.
date,
Right.
because the
So
check
you
cleared in
covered,
December. That's why.
right, sir. You covered the NRI wala section also. So there is one question with regard to NRI. Prince Agarwal from Gurgaon is writing, I have received inadequate or excess consideration for issue of shares to NRIs. Is it taxable under section 56 to 10?
If it is for inadequate consideration, so that recipient will hit, na? Will
Yes.
it will be income in the hand of recipient,
Okay.
correct?
Yes.
To the extent of difference.
CN Neil Mehta from Mumbai is asking question whether gift of unlisted share FMV is more than 50,000
Hmm.
to unrelated party be taxable in hands of recipient. If yes, what if the recipient does not pay tax on such gift? Will the gift giver will held liable for the tax on the same?
So the receiver, the person who has received for inadequate consideration, he is liable for for this income under 56(2)(10). If he is not filing the return and if he is not caught, then it's a different thing. But donor is not liable, donee is liable.
Giver is not liable. Donor is liable. Donee is not liable.
Donor
Sir,
is
can you
person who receives. Donor is not
okay?
liable. Ah,
Okay, donee is liable.
ah. But donor will have to pay capital gain, and yes,
Right.
transfer the shares at a FMV on FMV.
Nicholas Tucker from Nagpur is writing residential apartment purchased with the intention to sell and to held as a stock in trade in books can be covered under section 56 to 10.
Yeah, it will be covered. If there is a difference in the stamp duty value and the agreement value by more than 10%, then the 56 to 10 will trigger.
So there are more than 100 questions, sir.
You can email me, we will answer because
Yes,
we have another session. Even I want to attend 4 o'clock.
Questions are going on increasing now, and everyone has mentioned their mobile number and email IDs also.
Yeah, so I will give me 2 days time. I will try my best to attempt and email it to you.
Yes, yes.
Yeah.
I'll request the
Or we
backup
both
team.
jointly will attempt. I will take your
Yes, yes.
help also. Let us help the members, solve the members.
Yes, yes.
Hmm.
So one or two questions more I'll take, and then we'll conclude the session because we can't take all the questions, and we are grateful to the members
This
that they
subject
have.
is so wide, na, sir. This section.
Yes. Sir VG Tarak Nath from Hyderabad. His question is my question regarding interplay between the third provision of to section 50C1 and 56 to 10.
Hmm.
Said earlier to be answered, please. Why should section 56 to 10C be applicable to an investor in the preferential issue of by the company? Just a minute. Let me go to the original question.
Question is, I think both seller and buyer both are hit, right?
Yes, yes.
If it is for inadequate or the difference is more than 10% of the circle rate, both we are helpless. Seller will pay capital gain, buyer will pay income from other sources, 56 to 10.
Okay. So, Jatin Goel. Jatin Goelji has asked one more question. Definition of relative, it is mentioned that in case of HUF, any member thereof. So it means member is a relative of HUF.
Yes, sir.
My question is, does it also means HUF is a relative of member? Because my Tauji is a relative to me, but I am not relative to Tauji. As per yes, yes. This is very serious question, sir. Every member is a relative of HUF, then whether HUF is a relative of
HUF
the
relative of members of HUF only, not others.
So I'll repeat the question.
Hmm.
Definition of relatives, it is mentioned that in case of a Hindu undivided family, any member there, it is covered under the definition. So it means member is a relative of HUF. My question is, does it also mean HU is a relative of member?
Yeah. So HUF can give to member, member can give to HUF, but HUF cannot give to relative of the members of the HUF.
I think Jatin ji, you
सर
are
का
carried
क्वेश्चन
on.
वो है. हाँ. Suppose I can give to my brother, but my HUF cannot give to my brother.
Right, sir. Right, sir. So with this, we would need to conclude the session, and there are n number of questions, around
But
100.
I would like to
questions.
know the question so that we will attempt in 2-3 days time.
I'll request the technical team that please compile these questions and we can send it to the faculty, Prajapati sir. And Prajapati sir, please, it is your gratefulness and your dedication and commitment to the
Yeah,
fraternity.
we
You
will learn new
enrich-
things, sir.
Yeah.
New questions, new.
Yes, so we will conclude this session with thanking all the participants. Directors Committee also, through its chairman, he addressed us in his brief interaction with us in inception. And our Directors Chairman is also with
Chairman
us
has joined.
online. He's very curious and very dedicated to the profession, that he's still there to, and he observed, I think he was listening our question answer session
The
also.
whole direct tax committee you can see on the screen, Sanjay bhai.
Yeah.
PRD on my right hand side, she is the secretary to direct tax committee. And then there is the Namrata, Ravi is also there. I think so. He is not visible in the camera. Tushar is there. So we are working, as I said earlier, we are working on again certain suggestions to be sent to select committee. So thank you. Please go ahead. Please conclude.
Thank you.
Sanjay.
Thank you,
Yes,
Chairman,
yes,
sir.
there are sorry, sir. Prajapati, sir, you can talk, sir. Please.
Yeah.
Allow.
Thank you, Chairman, sir, for your opening remark. Again, at the time of conclusion, again, you have joined the session
My
because of
pleasure.
your busy schedule.
Thank you.
Thank you, sir.
Sir, some points have popped up while discussion 56 to 10 also. There are issues which we can take up for representation, and there are members are ready to provide some feeds to us. We'll discuss on this, sir.
Okay.
Yes, sir. Thank you so much on your behalf. Already assured, come forward and forward the memorandums to the institute. We'll take up for discussion, and then later on we'll decide how to proceed further.
Definite.
So that kind of assistance, guidance, and support we always get from the Directors Committee, ICAI. And this time we have the able leader to chair the Directors Committee in form of our beloved Piyush Hajar sir. Also, we appreciate the effort of a whole technical team who supported this object. Also, I appreciate in absentia Vishnu Agarwal ji, because he contacted me last week and uh, he actually insisted me that Sanjay, you should be there. It is learning session for me also, and behind the scene, everyone is putting their efforts. I appreciate the Vishnu Agarwal ji sir also for bringing the correct faculty to share his wisdom with us. Also appreciate the efforts of all the technical committee and the participants. Last but not the least, more than 100 questions we received post session. That shows that members are very much engrossed and they are very alert and agile about this topic. I believe that one session is not enough.
Yeah,
I'll
very true.
request the committee and WRC also and other region also and the center committee also. We should have such sessions very often, sir. And this kind of hand holding and mentoring will definitely help the members. So I'll conclude the session. If anyone from the committee would like to say something about it,
No.
otherwise I'll
Thank you.
conclude.
We can conclude. We can tell that came to
Thank you,
stop
Chairman,
here.
sir. Thank you, Vice Chairman.
Thank you, sir.
Sanjay ji,
Thank
and
you
thank you
very
all
much.
the participants who have raised so many issues that will increase our knowledge, and we'll try our best to answer within few days. Thank you for giving this opportunity. I see. Thank you, Sanjay ji.
Thank you. Thank you very much, audience. Thank you very much, all the
Thank you,
team.
audience.
Ready, we can conclude the session.
Yeah. Thank you.